your Financial Legacy podcast. I am your host, Maria Ellis. On every episode, I will bring you my perspective and the perspective of my guest on financial and financial legacy topics. Here on the Financial Legacy podcast, we're changing lives one person at a time by creating your own financial plan and financial legacy to help you create and enjoy your financial success. Connect with us at financiallegacy.live for your complimentary consultation. So, we have received a number of inquiries from you wanting to learn more about the best ways to structure your business ownership and to create a business legacy. So, today I'm going to share with you some of the business ownerships that some of my clients use. So most small business owners start their business by creating a sole proprietorship. So in that case, you're responsible for everything, right? You're responsible for all the liabilities. You're responsible for all the sales, all the earnings. You are 100% responsible for it. Then if you have more than one partner, some of my clients, what they decide to do is to create a partnership, right? So be able to offer services to your clients as you work together with some partners. The form of ownership that the majority of my clients have, however, is what is called a limited liability company. So what is a limited liability company? It is best for your needs because, like the name says, you have limited liability. So, among the different business structures, sole proprietorship, for instance, is considered the most basic and simple form of incorporation, right? Part of being a common preference by business owners, it is also solely owned by one individual, right? So the sole proprietorship, the business owner is entitled to all the profits and is also responsible for everything that the business does, including the business debts, any losses, any liabilities, right? So some of the advantages include having no boss, as an example. People who want to start their own company and say, I want to be my own boss. Well, that is true. You will be your own boss and will be responsible for everything. If you are a sole proprietorship, then it's easy to manage it. It's not very expensive to create, and you as the business owner will have complete control of everything that has to do with the company, including taxes, preparing your taxes, your quarterly taxes. So what are some of the disadvantages? Disadvantages include the unlimited, and I emphasize the word unlimited, personal liability that you will have if you own the company as the sole proprietor. Because there is no legal separation, right, between you and the business. And so you are held responsible for all the debts and the obligations of the business, including any liabilities that some of your employees' actions may cause. So also, if you need additional capital, as an example, it is hard to raise money if you are the sole proprietorship. So those are some of the disadvantages, right, of owning the company as a sole proprietorship. When it comes to taxes, because you as a proprietor and the business are one in the same, the business itself is not taxed separately. The sole proprietorship income is taxable income, right? So the income and losses and expenses are reported on Schedule C of your tax forms. So here in the United States, we have the 1040 form. So the Schedule C is part of that. And the bottom line from the Schedule C gets transferred to your personal tax return. So it's your responsibility to withhold and to pay all taxes, including self-employment and estimated taxes on a quarterly basis. So, but if you are, for instance, if you decide to create a partnership, you will also be responsible, right, for the debts of the company. And if one partner, if let's say you have two partners and you are one of the partners who have the most assets and most money, you will be responsible for all the debts accumulated by all the partners. So again, you're not protected there. Um, and what I like the most, and is in terms of form of doing business, is what is called a limited liability company. So it offers the greatest benefits when compared to partnerships and sole proprietorships. Most partnerships and sole proprietorships often switch. They start perhaps as a sole proprietorship or they start as a partnership. But then as time develops and they understand more of how the limited liability company works, they tend to switch to what is called an LLC, because doing business as a limited liability company or an LLC, if the company were to go bankrupt, as an example, you as a member may only lose your initial investment, but the creditors cannot touch any of your assets. So you are protected personally. So you will be exposed as to the extent of your initial investment, but the creditors will not come after your personal assets. Some of the advantages of an LLC, the limited liability company, includes what is called the continuous existence. So it's easy to transfer. You could share ownership in the company. It's easy to raise money, and it's also very important for estate planning. And we could talk a little bit about estate planning in future conversations. So a limited liability company has perpetual existence. When you create a limited liability company, you must have separate bank accounts, filing annual reports, and following all the requirements based on the state that you live in and operate from. So that's very, very important. Another important advantage of a limited liability company is that all the assets and accounts may be transferred by simple assignment of interest in the company. With a limited liability company, the owner of a business can share. You can share the profits of a business without giving control of your business. So you could own 100% of your company and decide only to, distribute your earnings in depending on the contribution of each of the members. So this is done by setting up what is called a share of profits separate from the share of the ownership. So that's part of the creation of the limited liability company. Another advantage is trying to raise capital. As your business grows and you're trying to raise capital, the limited liability company may raise capital by admitting new members or by borrowing money. So in most cases, a business doesn't pay taxes when you actually are raising money and selling your shares, right? You will be paying taxes on a quarterly basis based upon your revenue and your income. The creation of the liability company allows you to have different classes of ownership, as we discussed earlier, different distribution of profits and different levels of control. So that it gives you as the owner that flexibility. Another important consideration, and I'm all about estate planning, is in the situation where you pass on, a way to minimize the amount of taxes that you pay is to transfer your life tax-free each year a portion of your company to your heirs, your children. As always, consult, of course, with your tax attorney and your accountant, and certainly follow what is called the Internal Revenue Service rules, because they have to be followed very carefully. They tend to be very complicated. Some of the disadvantages of creating a limited liability company is that it tends to be expensive. And also, you may have to pay unemployment compensation for yourself, which would not, if you were a sole proprietorship, you don't have to do that. So, what I would like to do now is just share with you what some of my clients have done. And I'm having in mind a client that actually was able to use all of those three business ownerships. And he used a combination of the sole proprietorship, the partnerships, and the limited liability company to suit his own business and family objectives and preferences. He had basically, he was in the automobile industry, so he had different branches. So those were created as sole proprietorships. They were created, some of them were created as partnerships, and then eventually he had the LLC. Also, because of the nature of his business, he owned a lot of real estate, so it was important for him to keep assets separate. So this client created various companies with different types of business ownerships to take advantage of the tax laws and to accommodate the family and the business legacy. So this entrepreneur, just to share with you this story, this entrepreneur has three daughters, and he wanted to make sure that they all had an opportunity to run their own businesses, all their own dealerships, right, automobile dealerships, and so which also included real estate. So this client decided to create what is called a family charter or a protocol for his various businesses to enable the family to be united in their decision making and to promote both short as well as long-term goals for the family as well as for the business. So it's very important to have a charter. And what does the charter contains? It basically is a document. It's a living, breathing document that specifies some of the rules and responsibilities, obligations relating to the ownership and the management of the companies, as well as the values that will guide the family members to behave and conduct business in the community, right? So this particular client created this very effective family charter that captured the important benefits, both tangible as well as intangible, to facilitate the smooth process for leadership succession, right? So as he had three daughters, he wanted to make sure that there was going to be a family succession. So by creating a well-established and codified formal plan for success, enable the family and the business to continue to grow and to be profitable. So this is an example of how, by planning ahead, you could provide certain guidance to future generations. So frequently, it has been my experience that family charter also promotes family cohesion and bonding through philanthropy, because once you're working and doing well within various, locations, they like to be able to get involved in the local community and to support different nonprofit efforts within their community in an effort to give back to the community as they have done so well in those areas. So having a family charter which specifies some of the nonprofits that are in alignment with their own value is important, right? So as new generation comes on, they know what their family would like to do. So sometimes if the business owner doesn't specify the rules and the responsibilities that they envision for the business, it may actually lead to not too happy consequences, right? So you actually have seen companies, family businesses, that in the second or the third generation, they tend to fail. They tend to have disastrous consequences because the family and did not have a clear guideline, clear expectations for future generations. So, as I do my work, one of the companies that I have, obtained feedback from has been from the Boston Consulting Group, which through them they have they're very involved with family charters, and they sort of provide guidelines for that. And some of the things that you may want to include in the family charter is to be able to provide clear guidance that can relieve the stress for the new generation and also give peace of mind to you as the founder of the company, right? Um, the charter should specify the term of the charter and the process for revisions. So if the new generation comes on and they want to update the charter, they could do that because they have that already in place, right? It specifies the term of the charter and the process for revisions, including how long will the charter remain in effect and how the term can be extended or renewed, as well as the process for amending or adding new provisions to the charter, depending on the values of the organization and then the changes in the marketplace, right? So all those things are part of making sure that this is a breathing, living document that you could work with and make adjustments. So we talked a little earlier about specifying, those philanthropic efforts. I know that in whether it's local, regional, global joint activities that you may want to have with the family, with potential clients, it provides you with an opportunity to do some more bonding. The family charter also specifies a family member succession, right, and involvement in the business. And that's, as you know, very important, right? As your business grows, you want to make sure that there is an opportunity for family members to become active within the organization. And by giving them principles that will guide them with leadership succession and how the family members' performance will be evaluated and compensated, that's very important. So having that as part of the family charter is important. It also establishes guidelines for management of business ownership and what restrictions and incentives should be in place to give ownership of the business within the family, if that's what you want to do, right? Some organizations, some business owners want to just maintain the business ownership within family members. So that's something that needs to be added to the charter. The family charter will also address the governance and how should the family be organized and governed to achieve the company's vision and to promote the values of the companies as well as the family and the values that evolve over time, right? The government structure must also re-examine and renew based on family values and market environment, as we said a few minutes ago. It will also identify the family core values and the vision for its role in the broader community. Philanthropy, building relationships with clients, potential clients, is part of, the family legacy. So it also helps to build and support the business brand, right? It promotes employee engagement. So employee engagement is very important, and good corporate citizenship, right? You want to do business, you want to do well, you want to share values, you want to be part of the community, you want to contribute, right, with all the nonprofit work that is being done in the community. So family, and just to close on that concept, the most important in a family charter, one of the most important things that a family charter should specify is who is considered a family member, right? Who is considered a family member? That's a crucial question. Traditionally, as you know, a family is a group of persons related to one another by blood, right? By blood, or marriage, or a group of parents and children living together in a household. That's traditionally what family we have seen. The definition of a family. However, there's no right way to define a family, as you know. Family could be a group of people affiliated to bonds of shared history and commitment to share a future together while supporting the development of well-being of individual members, right? So in some instance, for instance, the leadership role is passed on to a daughter-in-law or to a son-in-law. And I'd like to give you some examples of that. For instance, at Walmart, which is a very large family-owned control business, right? Greg Penner, the grandson-in-law of the founder, Sam Walton, took over as the chairman of the board from his father-in-law, Rob Watson, in 2015. So there you have an example of son-in-law taking the helms, running the business. So according to the Harvard Business School professor John Davis, a family or a non-family member, whether within the family enterprise or outside it, can be an effective CEO, right? If you want to grow your business, you want to bring the business to the next level, you want to consider also not only inside but also outside members. And as you know now, with more women in business, we're seeing more women being involved in their own family business on a day-to-day management. So who comes to mind, for instance, is at Fidelity. At Fidelity Investments, we have Abigail Johnson, right? So she is responsible for the Fidelity Investments in Boston. There you have an example of women, at the helm and growing companies at the very top level. In France, as an example, we have Delphine Arnault at Louis Vuitton. So there is another example of more and more women being involved in growing businesses and growing family businesses in general. So this is very exciting. I find this very exciting to see more and more women involved in the day-to-day management of companies, especially when it comes to family businesses. And also, in large companies as well, we're seeing more and more women being involved. So happy to share that, as you know, makes me smile. So in closing, I would like to thank you for tuning into the Financial Legacy Podcast here with me, Maria Ellis. To learn more about how you could work with me, go to financiallegacy.life. Here, the Financial Legacy Podcast, we're changing lives one person at a time to help you create and enjoy your financial success. Connect with us at financiallegacy.life for your complimentary consultation. Thank you. Namaste.
In providing answers, neither Maria Ellis nor the Financial Legacy Podcast and guest speakers are acting as certified financial planners, advisors, certified financial analysts, CPAs, economists, accountants, or lawyers. Neither Maria Ellis or the Financial Legacy Podcast and guest speakers make any recommendations as to any specific securities or investments. All content is for informational and general purposes only and does not constitute as financial or legal advice. You should consult your own tax, legal, and financial advisors regarding your particular situation. Neither Maria Ellis nor Financial Legacy Podcast and guest speakers accept any responsibility for any loss that may arise from accessing or reliance from any information in this podcast. And to the extent permitted by law, we exclude all liabilities for any loss or damages derived directly or indirectly arising from the use of the information.